Hi, thank you for watching. This is Peter with Wahing Realty again, and this is another episode on my newsletter. The last two episodes we talked a little bit about rental properties. If you couldn't find it, you can send me an email, give me a call, and I'll send those numbers, send those links to you. And we talk about net operating income and the cap rates for buying rentals. How do you determine whether or not a rental property is good? How to do the numbers. And the second episode, what we did was we introduced a property that's a condo, $400,000, $2,500, $2,500 in rent, and we went over the appreciations. Nationally is about 3%. We went over depreciations and how does it affect your tax rate. The 1099A, the 199A, the new tax law, we mentioned this last episode. And we talk about the return on investment. If you buy this property with cash, your return on investment is about 7.8% return. Now that's pretty good with most people, but how do you make it better? So one way to do it, well, there's a way you can fix it up and then charge more rent. That's one way, right? But another way to do it is through leveraging other people's money. So in this case, it's a bank. Let's take a look at what happened if you borrow $200,000 as a mortgage. How does it affect your bottom line? Okay, for this particular case, we're just gonna borrow half. Okay. Okay, so we're gonna assume $200,000 with an interest rate of 4.5%. So I've already done the math. Let's do principal and interest. 1013.37, and let's separate it into interest and principal. The interest is $750, I believe. Yes. And the principal is $263. Okay. Hope you guys can see that bad handwriting. You guys probably know already. So let's look at cash flows. Originally, we have $15,000 worth of cash flow. Now, if you subtract, 15K is $1,250 a month, and you subtract that, your mortgage payment, you get 236.63. Right, so you get 236.63 a month, but just directly minus that times 12, we get 2839.56. So you were like, hey, how come we went from all the way from this to this? That doesn't seem like a lot, right? So the cash flow really diminished if you have taken a mortgage, but everything else didn't change. So let me talk about the real cash flow, right? Since this number consists of principal and interest, we took out the whole principal and interest here, but principal you're actually paying yourself, right? So if you add the principal to it, the 263, right, plus 236, right, and you multiply by 12, your real kind of cash flow is $6,000 a year. So 2,800, you can actually see it in your pocket, right? And the other 3,200, it is reducing your principal. So every month you own a little bit more of your properties. Got that so far? So let's look at the real return now. So this number went from 15K to 6K. I know, bummer, right? And this number is the same, right? Appreciation is the same. Tax savings are the same. So if you, oh, one more thing. Interest is actually your business expense. So you have tax saving on it as well. If you have negative cash flow, or if you have income, you can offset it by the interest. And we kind of do it the same way as the depreciations. You multiply by 33% to calculate the savings. So so you have 750 as your interest. If you multiply it by 12, that's $9,000. And if you multiply it by 33%, you get 2970. Right? So this is tax saving from interest. Right? So 2970 plus 6,000 plus 12K plus 3216 plus 1,000. I already did the math. It's 25,186. And you're gonna tell me, hey, it's a little bit less than that. So how come the return is bigger? The reason is, instead of taking $400,000 out, you're only paying $200,000. So if you divide that by 200,000, instead of getting 7.8% return, you are getting 12.59. So, and this I'm gonna have my kid fix it later. 12.59 is a lot better than this one. So what's the catch, right? The catch is the bank need to lend you this money, right? That's part of it. Yeah, my cat liked to do videos with me, and the bank need to send it to you, right? And because your cash flow is less, if the tenant, you have a problem with your tenant, or like the roof is leaking, well, condo usually the HOA fix it, or if there's any repairs that need to be made, or if there's any vacancy, the impact for your cash flow would dramatically increase. So, do it, I would suggest not to do it like a 5% down, and barely get a $50 cash flow. I probably would stay away with negative cash flow, but I have known a lot of people with no cash flow or negative cash flow made a lot of money because of the appreciations. So yeah, it depends on your personal preferences. So yeah, you have to make that decision for yourself. In Bay Area, appreciation will eat everything else up in a heartbeat. But in some other area, I own some rentals in Texas. Appreciation probably is like less than 3%, but the net operating system, the cap rate is a lot better, and so the math would work a lot differently in those areas. So if you have any questions regarding to the math, you can give me a ring, send me an email. If you like this episode, yeah, let me know. And until next time, thank you very much for watching.